Hello, and welcome to the August Economic and Market Update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. It was a good month overall for the markets, with most ending the month up. The best performers were the NASDAQ, thanks to tech stocks, and emerging markets as investors moved back into riskier positions. While the headline numbers looked good, though, the details are a bit more complicated. At the start of the month, the news was very positive. With the virus largely under control as of mid-June, states around the country reopened, and this gave us strong job gains and declining layoff numbers. That, combined with a rebound in consumer confidence, brought consumer spending back close to almost pre-pandemic levels. Business confidence also moved back into growth mode, and investment rose as factories reopened. And markets moved up on all this good news. During the month, though, the data turned less positive, and the second half was much weaker. We saw infection counts go up, as did fears of a second wave, and that led to state-level closures, which have hit both hiring and confidence and have certainly slowed the recovery. Rising concerns about federal stimulus payments have also raised the economic risks, and that took several of the indices down from the mid-month levels and signaled there may be more volatility ahead. Things look less certain than they did a month ago, and again, markets are responding to that. Despite the bad news in July, though, conditions are starting to improve again. The second wave of infections looks like it's peaked. Confidence is pulled back, but it remains above the levels we saw after the first wave. And consumer spending is still close to pre-pandemic levels. Yes, the data shows the recovery may have slowed, but it's still moving forward. And it also suggests conditions are likely to keep getting better. While the medical risks are real, we're now moving in the right direction. We know what to do, and it's working again. We've seen a slowdown in the recovery in response to the second wave, but as that passes, activity is likely to pick up again, this time from a higher level. And while the federal government is moving slowly on another round of stimulus, it will likely get there eventually. And that's what the stock market seems to be expecting, as values are still close to all-time highs. That's also what the data is suggesting, because as companies have started to report earnings, the news has been substantially better than expected. All in all, it looks like this is more likely to be a pause than a reversal of the recovery. And after a much sharper than expected recovery over the past couple of months, a pause is something we shouldn't be too surprised at. Setbacks were inevitable, but the good news is that we're now moving past them. While the risks are real overall, we're still in a much better place than we were a couple of months ago. That's it for this month. Join me in September for the next monthly update. But until then, be sure to check my daily blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. And thanks for watching.